Okay, hello everyone. Now, in today's class, we are going to attempt a question from Mar-Jun 2024. This question is LITTLEBREEDY company. So I'm going to read the obviously exhibits from the question, and then we will try to find a solution for this. Okay. The following exhibits available on the left-hand side of the screen provide information relevant to the question. Okay, so there are some exhibits. Information should be used to answer the requirements. Okay, let's start first exhibit. Let's expand it. So the question is, the first exhibit, LITTLEBREEDY company is a supplier of furniture and equipment. The company is a supplier of furniture and equipment. LITTLEBREEDY is listed on its local stock exchange and is subject to principles-based corporate governance code. LITTLEBREEDY's board is currently considering two major investment projects. One is an investment in facilities to manufacture office pods. The other is an investment in facilities to manufacture furniture and equipment for schools and universities. Okay, that's the exhibit one, that LITTLEBREEDY is a supplier of furniture and equipment. Okay, so company supplies furniture and equipment. Okay. So company is already dealing in furniture and equipment, and it's currently considering two projects. One is an investment in facilities to manufacture office pods, and other is investment of schools and universities furniture. Okay, this is exhibit one. So the first investment opportunity is office pods. So let's see what it gives information about office pods. The investment required for the manufacture of office pods can be assumed to happen very soon, and production for a full year will start almost immediately. Okay, so you can assume that investment will be made very quickly and production will start almost immediately. Revenue and contribution figures over the 4-year life are. So it has given revenue, it has given contribution. There is no need to be happy that revenue and contribution is already calculated, because if you had to calculate it, you would gain marks. They have directly calculated. That means your easy marks are not possible here. So revenue and contribution is given. Fixed costs will be 8 million in year one, rising by 5% each year in year 2 to 4. Initial investment in non-current assets is expected to be 60 million. Tax allowance of 100% is available immediately on this investment. Year 4 realizable value of the investment can be assumed to be 5 million. This amount will be taxable. Okay, so realizable value is 5 million and this amount will be taxable. Usually the scrap value is not taxable. It's never written in the question, neither we take it, but this is taxable. Working capital at the start of each year is expected to be 10% of sales revenues for that year. Any remaining working capital will be released at the end of the project. So working capital at the start of each year is 10% of revenue. Taxes payable at an annual rate of 20% on profits in the same year. Means profits rise, tax losses must be carried forward and offset against future profits. The applicable cost of capital is 11%. Seems to be an easy case. Okay. Next opportunity was schools and universities investment, school furniture. Okay. LITTLEBREEDY has not previously supplied furniture and equipment to schools and universities. On the basis that LITTLEBREEDY is only supporting existing facilities, calculation suggests that the proposed investment would have a negative NPV of 7 million. However, government has just announced a major program for support for the expansion of schools and universities over the next 10 years. If this expansion goes ahead, LITTLEBREEDY's finance director has forecast that demand for product would justify 80 million additional expenditure on manufacturing facilities in 4 years' time. The present value of the income from this investment is estimated to be 52.7 million. It can be assumed that all costs and revenues include inflation. Applicable cost of capital is 11%, risk-free rate 3%. CEO has estimated that likely volatility of cash flows at a standard deviation of 25%. Now pay attention to the second option. LITTLEBREEDY has not supplied furniture and equipment to schools and universities. On the basis that LITTLEBREEDY is only supplying existing facilities, calculation suggests that the proposed investment would have a negative NPV of 7 million. However, government has just announced a major program for expansion of schools and universities over the next 10 years. If this expansion goes ahead, LITTLEBREEDY's finance director has forecast that demand would justify 80 million additional expenditure. So additional expenditure. Okay. So on manufacturing facilities, and present value of this additional expenditure is 52.7 million. Government is planning to expand the schools, and finance director is saying that this would justify 80 million additional expenditure, and present value is 52.7 million. All revenues and costs include inflation. Cost of capital 11%, risk rate 3%. CEO has estimated that volatility has a standard deviation of 25%. Okay. Last exhibit. LittleBreedy's board feels that the company has been too dependent on demand from office sector. Okay, so now they're thinking that company has been too dependent on demand from the office sector. Hence, it is looking at the investment in the furniture and equipment for schools and universities. It is also considering the production of furniture for other types of organizations. Board believes that decisions it is considering now about investment policy will be important for the future direction of the company. The board does not want to disclose its plans in detail until they are certain for commercial reasons. LittleBreedy's fulfills statutory reporting regulations and complies with all the requirements of the corporate governance code to produce an annual business review. However, it has faced investor and media criticism that the analysis and commentary on business which it publishes in its business review is insufficient. Recently, LittleBreedy's business review has been primarily a detailed commentary on highlighted figures from the financial statements in the annual report. The main criticisms of it have been that it does not disclose clearly the business future investment strategies and discusses its results in the context of achieving strategic objectives. So these two paragraphs seems to be going towards a theoretical requirement. That first paragraph states that the LittleBreedy's board feels that the company is now too dependent on demand from the office sector. Hence, it is looking at investment in furniture and schools. It is also considering for other types of organizations, and it does not want to disclose business plans due to commercial reasons. Now, in the business review, people are criticizing that they don't publish their annual review in the second paragraph. And media comments suggest that the lack of clear information about LittleBreedy strategies has been the main reason why its share price has recently fallen. So media is saying that the lack of clear information about strategies is the major reason why share prices fall. Okay, this ends exhibits all four. So the first exhibit was introduction, that it's listed on a stock exchange. It has two investment opportunities, one to manufacture office pods and other for schools and universities furniture. Office pods, all investment details were given, revenue, variable cost, contribution. Okay, then for this schools and universities, the present value is 52.7 million. 80 million additional expenditure is being planned, and currently NPV is 7 million. The standard deviation and thing risk-free rate is given, and then some media criticism. Okay, let's move towards the requirements. Requirement is 7 marks. Evaluate the financial acceptability of investment in office pods. So evaluate the financial acceptability for investment in office pods. You all know that financial acceptability is evaluated via NPV. So we basically need to calculate financial acceptability NPV. Financial acceptability is also evaluated by APV, but you know that there need to be certain conditions for APV. But if it's not present, then like a major portion via debt and stuff like that, subsidized loan, if they're not present, then financial acceptability via NPV. So office pods financial acceptability is via NPV. So we will go towards office pods data and try to find the financial acceptability. Okay, now if we try to make financial acceptability via NPV, so let's start it to decide whether financial acceptability is there via NPV or not. Okay, so for that, it's a 4-year life, right? So 0, 1, 2, 3, and 4. So we have investment first. What is the investment? 60 million. So negative 60. Okay. Then after investment, we have revenue and contribution. Okay, so revenue less variable cost equals contribution. So I think we should directly start with contribution. You can also like write this like revenue 60, contribution is 24. Take the difference, that is variable cost 36 million. So you can write revenue 60, variable cost 36. This is how you can show, or you can directly start from contribution, won't make any difference. 24, 42.3, 40.1, 34.1. Then we have fixed cost, 8 million year one, rising by 5% each year. Okay. So the only difference is that I didn't write revenue less variable cost less fixed cost. I directly started from contribution, because you can do it like this, that you write revenue 60 million, then deduct variable cost of the difference, that is 36 million, then deduct fixed cost. That is also fine, or you can directly take contribution less fixed cost. Okay. Then we take TAD. Okay. So either use the tax savings from capital losses approach or the TAD approach. Okay. So TAD is 100% on this investment. Okay. So you don't get 20% every year, or the straight line method, you get 100%. Okay. So that means TAD is 100% of the investment, 60 million. Okay. We deduct TAD and add back. Okay. After doing this, we get taxable profit. Remember, revenue less variable cost less fixed cost less TAD. So TAD is 20% each year. So you write 20%. Okay, TAD is straight line. So you deduct straight line. Okay, it's 100% immediately. So 100% of the investment, 60 million. Okay. So this makes it from of D4 to D6. You can drag it. Okay. Then tax is same year at 20%. Tax is same year at 20%. Okay. Tax losses must be carried forward and offset against profits from the same investment. Okay. So losses need to be carried forward. Okay. There is loss, no tax. Okay. This 44 million will be offset against future profits. So this 44 million gets offset against 33.9 million. Okay. So still completely it's not offset. Okay. Let me open the calculator. 44 million is the loss and 33.9 million is the profit. So it gets offset against future profits. Okay, still 10.1 million losses there. Still 10.1 million losses there. So zero tax again here. Okay. And now 31.28 million is the profit here. Losses will get offset. You don't have complete loss, only 10.1 million losses left. Okay, because out of 44 million, 33.9 million was offset completely. It was offset against losses. So all profits gets offset against loss, no tax. Now in 31.28 million, you need to pay 20% tax, but 10.1 million is still left to be offset. Okay, you will offset it. And whatever the profit is left, you will pay 20% tax on that. Okay. And here, all losses are now offset. Okay, no losses left. So directly 24.839, 20%. Okay, this is the working of tax. I hope that's clear to you. So I hope the tax issue is clear to you, because we wrote investment, then contribution, then fixed cost, then TAD 100% was available, not 20-30% each year. So we would have made it like this, but 100% immediately available. So we made full 100%, 60 million. Taxable profit. Okay, then tax. So losses are to be carried forward. 44 million is the loss, no tax, then offset against future profit of 33.9. Again, tax, still 10.1 million left. So offset against here. 31.28, 10.1 million. The left one is got offset, then 20%, and then no amount left. So 24.839 million into 20%. After tax, we add back TAD. So add back TAD, you only deducted 60 million once, so add back once. Otherwise, in every year, if it's deducted, we add back every year. Okay. Then working capital investment, working capital recovery. Okay. Let's show working capital investment in working one. Okay. So working capital investment in working one. So question stated that working capital required at the start of each year is 10% of revenue for that year. So at the start of each year, 10% of revenue. So 10% of revenue means working capital at the start of each year required is 10% of revenue. So 10% of 60 million. Then 10% of revenue, 86.4 million. Then 10% of revenue, 86.4. Then 10% of revenue. So 10% of revenue working capital is required at the start of each year. Okay. So it's required at the start of each year. That means it's required at the start of year 6. It's 6 million is required at the start of year 1. So at the start of year 1 means I will put it in year 0. Okay. Then 8.64 is required at the start of year 2. So at the start of year 2 means I will put it in 1. At the start of year 2, it's required. That means I will put it in year 1. So 8.64 is required. But I have already invested 6. So 2.64 will be placed. Okay. Then at the start of year 3, 8.64 is required. At the start of year 3, 8.64 is required. At the start of year 3 means end of year 2. At the start of year 3 means end of year 2. So 8.64 is required at the end of year 2. So I've already put 2.64 and I've already put 6. 0. Okay. And 7.78 is required at the start of year 4. So 7.78 is required at the start of year 4. I will put it in year 3. 7.78 is required at the start of year 4. I will put it in year 3. So at the start of year 4, that means in year 3, 7.78 is required. And I've already put 0, 2.64 and 6. Okay, so I need to pull back, not invest more, because if 9 million was required, I would have invested more. But if a lesser amount is required, I pull back. Okay, and whatever has been invested, it will be recovered. Okay, so I invested 6. Okay, I invested 6. I invested 2.64. And then I pull back 0.86. So whatever is left, it still will be recovered. In the last year, 7.7, it will be recovered. Okay. So I hope this working capital topic was clear to you, because working capital, 10% of revenue at the start of each year. At the start of each year means year 1, year 2, year 3, 4 start. That means 0, 1, 2, 3. So 6 million was required. I put it in year 0. Okay. At the start of year 2, that means in year 1, 8.64 was required. I've already put 6, so 2.64 more. Then at the start of year 3, end of year 2, 8.64 required. Already put 8.640. In the start of year 4, that means year 3, 7.78 is required. I've already put more. So pull back, and whatever is left has been recovered. Okay. After that, there is scrap. So normal case scrap value is 5 million. Okay, so I would have written 5 million, okay, as inflow. Okay, but since it's tax allowable, that means I have to pay tax on that 20%. Okay. This is something different from the previous past papers, because you just put scrap value as inflow, 5 million inflow. But if it's tax allowable, you have to pay 20% tax on that. Only do this if it's written, not do it every time. Scrap value, 5 million inflow. But if it's written, it's tax allowable, pay 20% tax on that. Okay. So after that, I think everything is there. You don't need to add tax saving from capital allowances because you have done the TAD approach. Okay. If TAD is not there, we don't deduct TAD and add back TAD, then we in the end add back tax saving from capital allowances. Okay, but if it's TAD, SN tax savings has already been incorporated from capital allowances, no need to adjust them separately. Okay, so after that, you get net cash flows. So once you get the net cash flows, okay, you can multiply it with discount factor to get present value and NPV. So discount factor is 11%, I think. Yeah. So you can write from the table discount factor 11%, present value and NPV, or you can use the NPV function. So equals to NPV bracket open, the discount rate 11%, comma, NCF from year 1 to last, T13 to G13, bracket close, plus NCF of year 0, C13. Okay, you get NPV 14.8 million. Okay, and you were asked to evaluate the financial acceptability. Okay, so we will write that since NPV is positive, project is financially acceptable. I will write it. Okay, in the meantime, please copy this. Okay, please copy the solution. Okay, NPV is positive, so project is financially acceptable. However, because we have to gain professional marks as well, so always a questioning mind. However, NPV is based on many assumptions and company must consider those assumptions before reaching a formal decision. Okay, please note this so that we can move forward. Okay, let's move towards the next requirement now. Evaluate using the Black-Scholes option pricing model whether Little should proceed with the investment in furniture and equipment for schools and universities. Okay. 4 marks, usually because now the BSOP calculator is in operation, so the marks are less now. So evaluate using the BSOP model whether Little should proceed with the investment in furniture and equipment. Let's see what the schools and universities furniture data was. Little has not previously supplied furniture and equipment to schools and universities on the basis that Little is only supporting existing facilities. Calculations suggest that the proposed investment would have a negative NPV of 7 million. So the proposed investment, remember in the introduction, you had two options. The first was to investment in facilities to manufacture pods, the NPV is calculated. And second was to manufacture furniture and equipment for schools and universities. Okay. So there were two options. For the first option, NPV was calculated. For the second option, schools and universities. Little has not previously supplied furniture and equipment to schools and universities on the basis that Little is only supporting existing facilities. Calculations suggest that the investment is negative NPV of 7 million. However, the government has just announced a major program for supporting expansion of schools and universities in the next 10 years. If the expansion goes ahead, Little finance directors forecast that demand for product would justify additional expenditure. Okay, what is additional expenditure? Okay, additional expenditure is option to expand in BSOP, right? There were options: option to delay, start late, option to expand, more investment, and option to early exit. So additional expenditure is option to expand under BSOP. Okay, and present value of income is 52.7 million. Present value of income from this investment. Now, this investment of 80 million is going to yield 52.7 million. It can be assumed all costs and revenues include inflation, cost of capital 11%, risk-free rate 3%. Okay, CEO has estimated that likely volatility of cash flows or standard deviation of 25%. Okay, so after seeing standard deviation, it was clear that it's something BSOP. In the requirement also, evaluate using BSOP whether it should proceed with investment in furniture and equipment. Okay, so in furniture equipment, your NPV was negative 7 million. Government has announced expansion, and finance director saying additional expenditure of 80 million. Additional expenditure is option to expand. Present value of this investment is 52.7 million. Risk-free rate and standard deviation is given. And requirement using Black-Scholes whether it should proceed with the investment or not. Okay, so BSOP calculator. Okay, now if you talk about RST, so risk-free rate 3%. Okay, and deviation 25%, and time period 4 years for 3% and 25%. For 25% and 3%. Okay, this is I got RST. Now, in option to expand, what is PA and PE? PE is the additional investment. So what is the additional investment? 80 million. And present value of returns, PA is 52.7 million. Okay, you just have to include all of these that in BSOP option to expand additional investment, P is 80 million, present value of returns 52.7 million, RST is given. Okay, so putting all of this. Okay, so if I place the standard deviation as 25%, so in place of 25%, I have to write 0.25. T is the time period in years, 4 years. Remember, if it's 6 months, I used to write it in years, 0.5 years. It's 4 years, I will write 4. R risk-free rate is 3%. 3%, I will write 0.03. Exercise price of this additional investment is 80 million and present value of returns from this is 52.7. Okay. Once you place all values, it automatically calculate D1, D2, ND1, ND2, CNP. So which value we will take? Okay. Because the requirement was whether LITTLEBREEDY should proceed with the investment in furniture and equipment for schools. Okay. It has a negative NPV of 7 million. And then the additional expenditure and the present value and the RST. Obviously, all these things are further that requirement saying using Black-Scholes whether we should proceed with the investment. Okay. Now we just put all the values in the BSOP calculator because we were asked to use BSOP. So we will obviously use a calculator. Don't waste our time on manual things. Okay. So which value will select, C or P? Okay. Since option to expand is a call option, so we will use the call option value. That's 5.11 million. Okay. So 5.11 million is the call option value. Okay. And this is our answer. But when you will move towards the strategic NPV, because to take decision, we need to calculate strategic NPV. Okay. It's 5 million, 5.11 million. And the old NPV. What was the old NPV? It's 7 million negative. So again, this will result in 1.89 million negative NPV even after option. So it should not proceed with proposed investment, right? Because if strategic NPV is positive, then only we proceed. But if strategic NPV is negative, we don't proceed. Okay. So 5.11 million. Why I selected call? Because option to expand is a call option. Had it been option to early exit, I would have taken put option value. But if it's option to expand, it's a call option. I put the call option value and found the strategic NPV by mixing both options. Okay. So NPV is still negative. So I should not proceed with the proposed investment. Okay. Please note this. We have done 11 marks, just putting the values in BSOP calculator, picking from our mind that it's option to expand and solving that. Okay. Okay, so I got the strategic NPV by taking 5.11 as the call option value. And then for strategic NPV, the option value without that was NPV was 7 million. So 5.11 minus 7. The thing got, I think, deleted. So this makes it 1.89 million. Yes. So company should not go ahead with the proposed investment because strategic NPV is negative. Okay. Now I have done two requirements. The first requirement was evaluate financial acceptability. I said that financial acceptability states that it's positive, but again, due to professional marks, I have to keep a question in mind. But NPV is based on many assumptions. Company must consider those assumptions. And in requirement two, using BSOP, it asked that whether it should proceed with the investment. So I said it should not proceed with the investment because in BSOP, it was option to expand call option. Through calculator, I found the value and then I found whether we should go ahead or not. Okay. Then discuss the extent to which investment in furniture and equipment for schools and universities would represent diversification for Littlebreedy. Okay. Now discuss the extent to which investment in furniture and equipment for schools and universities. Remember, the company was planning to invest in furniture and equipment for schools and universities. See, Littlebreedy is a supplier of furniture and equipment. Littlebreedy is listed on a stock exchange and is subject to corporate governance code. Littlebreedy's board is considering two major projects. One is an investment in facilities to manufacture office pods. Other is an investment in facilities to manufacture furniture and equipment for schools and universities. So company is trying to make schools furniture for schools and universities as well as for office pods investment. So it's not asking about office pods investment. It is asking discuss the extent to which investment in furniture and equipment for schools and universities would represent diversification. Their opportunity is to manufacture furniture and equipment for schools and universities. You already manufacture, you already supply furniture and equipment. Okay, you are a supplier. Now you are planning to manufacture furniture for schools and universities. So it's asking, discuss the extent to which investment in furniture and equipment for schools and universities would represent diversification. Now, whether this investment in manufacturing furniture and equipment for schools represents diversification or not, this is the requirement. So I will answer it on the word processor via points, and then you can write the points as well. Okay. We're just giving our opinion whether this investment in furniture and equipment for schools and universities would represent diversification for Littlebreedy. So you can write Littlebreedy already manufactures, is a supplier of furniture and equipment, which means it is already in furniture market. Investment to manufacture furniture and equipment for schools and universities may represent slight diversification as schools and universities are a different market. It's asking extent to which this represents diversification, okay? It may represent slight diversification as schools and universities are a different market and may require different type of furniture than company is currently manufacturing. Similarly, rather than just being a supplier, company is investing in manufacturing facilities, which may mean a new venture. However, the extent of diversification primarily depends on how successful these investments are in future. But it does represent limited diversification from current operations. Okay. You see that the question's requirement was discuss the extent to which investment in furniture and equipment for schools, universities represent diversification. Now, company is currently a supplier of furniture equipment. It's considering two opportunities. One is to manufacture office pods, interior and assembled office pods. Other was investment facilities to manufacture furniture and equipment for schools and universities. So it was asking that whether the investment in schools and universities does represent diversification. So I just shared my point of view that companies currently already in furniture market, but it's a supplier. Okay. Manufacturing does represent limited diversification, and schools and universities may also represent limited diversification because schools and universities may require some different types of furniture than you are currently manufacturing. So it's just a viewpoint that whether this represents diversification or not. Okay, so please copy this. Okay. Last requirement, advise LITTLEBREEDY on what changes to make to its reporting to provide more information about the rationale for and the factors affecting the future investment strategy. So you need to advise on what changes to be made to reporting to provide more information and rationale about future investment strategies. Okay. Now, this particular part of 4 marks is coming from here, reporting. Okay. Let's just have a quick look on it. LittleBreedy's board feels that company has been too dependent on demand from office sector. Hence, it is looking for the investment in the furniture and equipment for schools and universities. It is also considering the production of furniture for other types of organizations. The board believes decision it is considering now about investment policy will be important for future direction of the company. The board does not want to disclose its plans in detail until they are certain for commercial reasons. LittleBreedy fulfills statutory reporting regulations, complies with requirement of corporate governance code to produce an annual business review. However, it has faced investor and media criticism that the analysis and commentary on the business which it publishes in its business review is insufficient. Recently, LittleBreedy's business review has been primarily a detailed commentary on highlighted figures from financial statements in the annual report. The main criticism of it have been it does not disclose clearly the business future strategies and discusses results in the context of achieving strategic objectives. Media comments suggest that the lack of clear information about LittleBreedy's strategies has been the main reason why its share price has recently fallen. So company does fulfill statutory reporting regulations, complies with requirement of corporate governance code, but media and investors are criticizing that you just are doing commentary on financial statements in the annual report. You don't disclose the future plans. Company does not disclose it because it wants to keep it confidential. Okay. But this is resulting in fall in share price. Okay. So requirement is that advise LittleBreedy on what changes to make to its reporting to provide more information about future investment strategies, what changes to make in reporting. Okay, now you have understood the point that their reporting is insufficient for investors and media. They want to hide their future plans. They do fulfill the statutory obligations, corporate governance requirements, but investors are saying that they are not getting future idea. And hence, this is resulting in fall in share price. So advise LittleBreedy on what changes to make to its reporting to provide more information about future investment strategies. Teapot. Although LittleBreedy is fulfilling statutory reporting regulations, and complying with corporate governance, still investors and media think that reporting is insufficient. Hence, they are criticizing, and this has resulted in fall in share price. An important factor that LittleBreedy must consider is that investors don't want detail about what happened in the past. They are more inclined towards future plans, which company is not disclosing due to confidentiality and commercial Reasons. Company can keep things confidential, but it must give an idea to investors about future direction. Just making a report having detailed commentary on financial statements only tells about past, not about future. So it is important to change reporting just to create an idea about future direction. Okay, so they are fulfilling regulations, complying with governance, but remember, investors don't want whether you're fulfilling corporate governance, reporting regulations. They want what is happening in the future. You have just made a report which highlights some key ratios of financial statements. So key ratios of financial statements only tells you what happened in the past. They don't tell anything about the future. So investors are not going to get attracted because of just your ratios. Although confidentiality is indeed important, but you must give investors a sound idea, at least about the future direction. Okay, so the reporting requirements must change to include not all, but just the future direction of the company. Okay, please note this as well. This question is now over.